JPMorgan reporting, they come out with earnings. Francine helping me with the headlines. They plan to increase their capital return in the first half of 2016. You're not hearing that from Deutsche Bank and other troubled banks. This is the JPMorgan distinction. Francine, one of the distinctions is they actually have headlines that are in English. It's always a joy to actually report on JPMorgan.
It is, Tom, that first quarter revenue a little bit better than analysts had estimated. So it's coming in at $24.1 billion. We had estimated, or analysts we had spoken to had estimated $23.8 billion. But I think you're right, Tom. The most important headline we have so far, we're going through it to try and match it with our estimates, is that they are planning to increase the capital return in the first half of 2016. Of course, JPMorgan, the most interesting bank because it's the bellwether for the rest of the sector. We then have a lot of competitors. Michael Moore, our expert in banking, is here with us. I know it's very early days because we're just going through the release, but actually this feels like not as ugly as it could have been. Yeah,
it's one of those quarters where it becomes so consensus that everything's going to be terrible that anything less than that is not too bad. And certainly when earnings aren't great, you talk about other ways of rewarding shareholders, and that's with returning capital, which is what they appear to want to do.
So the main headlines, Michael, first of all, so they're increasing their capital return. So basically this is saying, guys, we're not doing too badly, especially compared to our peers. We're going to give something back. That income revenue, also for the first quarter, that fixed income revenue. Now, this is crucial. A little bit also better than estimated. It's coming in at $3.6 billion. We had estimated a $3.2 billion figure. If they're not getting it wrong in fixed income, it puts them in a much better place than a lot of their rivals.
Yeah, certainly, and this had been a bad quarter for FIC, 3.6, not nearly as bad as some people were expecting. So that does put them ahead of the game on the revenue side and maybe allows for more comfort with this increasing the capital.
Yeah, I want to do two things here, Michael Moore, and Jim Bianco helping us out with his comments earlier. Tangible book, 48.96, up 8%, way out over a nominal GDP growth and, other usual credit mumbo-jumbo that looks pretty good. Buried halfway down is really sort of the worry du jour, which is oil. The provision for credit losses was $459 million compared to a benefit of $31 million in the prior year quarter, quote, primarily reflecting higher reserves in oil and gas, metal and mining. And Jim Bianco, this is a process. It's a multi-quarter process.
It absolutely is, and it is kind of critical not only for the banking system but for the energy system as well, too. They have to get the write-downs down. Otherwise, if they're not going to write down these loans fast enough, it suggests that they're going to leave some of them open, they're going to leave production too high, and that could put further pressure down on the price of crude oil. I like the
idea within the press release. And, folks, I'll be blunt. It's the clearest press release of all the banks that come out. They do talk about their fortress principles. Here's the market reaction. This is intraday and pre-market. We've had a number of good days for JPMorgan with a risk-on feel, and we got a nice percentage point up here. My eyes are failing me. That's 4.1%. I wonder, Francine, can Jamie Dimon do something about my eyesight? He's doing everything else.
Tom, if you look, let's just recap exactly what we learned and what investors will try and dig out of this earnings report, right? So first of all, it's revenue. It seems to be in line. Expenses, they seem to be in check. Trading, fixed income, a little bit better than expected. That will maybe put it, apart from some of its peers. And then we also need to focus on that oil and gas, which, Michael, was, of course, one of the big worries, right? That they were somehow linked, not just JPMorgan, but a lot of the big banks, that if a big hedge fund manager in the oil commodity space would go down, it may hurt them quite significantly.
Right, and just the loans to the producers and the E&P companies certainly driving that. And it looks like the total provision or credit cost was $1.8 billion, which was on the high end of estimates. And certainly a lot of that is driven by the oil and gas sector. So even to beat even with a higher credit cost is good.